Imagine being told that debt is bad, that borrowing money will keep you poor, that credit cards, loans, and leverage are traps designed to destroy your future. Now imagine discovering that the wealthiest people on Earth, billionaires, real estate tycoons, CEOs, and investors, use massive amounts of debt every single day. Not by accident, not recklessly, but strategically. While most people are taught to avoid debt at all costs, the wealthy are taught how to use it as a tool that accelerates wealth, reduces taxes, and multiplies opportunities. So the real question is not whether debt is good or bad. The real question is why debt makes some people richer while it destroys others. And once you understand that difference, your entire view of money will change. Debt itself is not the enemy. The problem is how debt is used. For most people, debt is emotional. It is used to buy things that lose value. Cars, gadgets, clothes, vacations, things that create pleasure but no income. For wealthy people, debt is mathematical. It is used to buy assets that produce cash flow or increase in value over time. This single difference explains why debt pushes one group forward while pulling the other backward. Wealthy people don't borrow money to look rich. They borrow money to become richer. To understand how this works, we first need to separate debt into two categories: bad debt and good debt. Bad debt is used to purchase depreciating items, things that lose value the moment you buy them. A car loan, for example, typically loses 20 to 30% of its value in the first year. Credit card debt for consumer spending often carries interest rates of 18 to 25%, making it extremely expensive. This type of debt drains future income and creates financial stress. Wealthy people avoid this kind of debt whenever possible. Good debt, on the other hand, is used to acquire assets that generate income or appreciate over time. Examples include real estate, businesses, income-producing stocks, or infrastructure. The key feature of good debt is that the asset pays for the debt. If a rental property generates more rent than the cost of the mortgage, taxes, and maintenance, the debt is effectively being serviced by someone else. Over time, inflation reduces the real value of that debt while the asset itself becomes more valuable. One of the most powerful ways wealthy people use debt is through leverage. Leverage means using borrowed money to increase potential returns. Real estate is the most common example. If someone buys a $1,000 property with $200,000 of their own money and $800,000 borrowed, they control a $1 million asset while risking only a fraction of that amount. If the property increases in value by 5%, that is a $50,000 gain on a $200,000 investment. That's a 25% return, not including rental income. Without leverage, that same return would require far more capital. This is not theory. This is how real estate empires are built. According to Federal Reserve data, real estate represents one of the largest components of wealth among high net worth individuals. The reason is simple. Long-term fixed-rate debt combined with appreciating assets creates a powerful wealth engine. Inflation increases rents and property values over time, while the mortgage payment remains relatively fixed. In effect, inflation works for the borrower, not against them. Another critical advantage wealthy people have is access to low-interest debt. Interest rates are not equal for everyone. People with strong credit, assets, and financial history can borrow at much lower rates. Large corporations often issue bonds at rates lower than inflation, meaning the real cost of borrowing is close to zero, or even negative. When the cost of debt is lower than the return on investment, borrowing becomes profitable. This is why major companies like Apple, Microsoft, and Amazon carry debt even though they have billions in cash. It makes financial sense. Taxes also play a massive role in why wealthy people use debt. In many countries, including the United States, interest on business loans and investment properties is tax-deductible. This reduces the effective cost of borrowing. At the same time, assets purchased with debt can generate depreciation deductions, further lowering taxable income. According to IRS data, real estate investors benefit significantly from depreciation, even when properties are increasing in market value. This legal structure allows wealthy individuals to report lower taxable income while their net worth continues to grow. Another strategy commonly used by wealthy individuals is borrowing against assets instead of selling them. When you sell an asset, you often trigger capital gains tax. But when you borrow against an asset, such as taking a loan secured by stocks or real estate, you receive cash without selling anything. This means no capital gains tax is triggered. Ultra-wealthy individuals often use lines of credit backed by their investment portfolios to fund lifestyle expenses, while allowing their assets to continue growing. This strategy is widely reported and used by billionaires and high-net-worth investors. For example, margin loans and securities-backed lines of credit are common among wealthy investors. These loans often carry lower interest rates than personal loans, and the interest may be tax-deductible, depending on how the funds are used. The borrower retains ownership of the asset, continues earning dividends or appreciation, and avoids selling at an inopportune time. This is a fundamentally different approach than using debt for consumption. Wealthy people also understand time better than most. Debt allows them to move faster. Instead of waiting 10 or 20 years to save enough money to buy an asset outright, they use debt to acquire it today. This matters because assets tend to rise in value over long periods. Historical data shows that U.S. real estate and stock markets have increased significantly over decades despite short-term volatility. By delaying ownership, you delay exposure to growth. Debt accelerates participation in the market. Another key difference is risk management. Contrary to popular belief, wealthy people are often more conservative with risk than average individuals. They do not rely on one income stream or one asset. Debt is spread across diversified investments. Cash reserves are maintained. Insurance is used aggressively. Debt is structured with fixed rates when possible to reduce uncertainty. This disciplined approach allows them to survive downturns and benefit from recoveries. The 2008 financial crisis provides a clear lesson. Many people lost everything not because they used debt, but because they used it irresponsibly. Short-term adjustable-rate loans, no cash reserves, speculative purchases, and no income buffer. Meanwhile, investors with conservative leverage and long-term financing were able to acquire assets at discounted prices. Data from the National Bureau of Economic Research shows that wealth inequality widened after the crisis, partly because those with access to capital and credit could buy assets when prices were low. It's also important to understand that wealthy people rarely personally guarantee every debt. Businesses and legal structures matter. Corporations and limited liability entities are used to separate personal risk from business risk. This allows debt to exist within controlled environments. Losses can be contained. Assets can be protected. This is standard practice in corporate finance and real estate investing. However, debt is not magic. It amplifies outcomes. When investments perform well, debt accelerates wealth creation. When investments fail, debt magnifies losses. That is why education, patience, and discipline matter. Wealthy people spend years learning before deploying leverage at scale. They analyze cash flow, downside risk, interest rate exposure, and exit strategies. This is not gambling. It is calculated decision-making. Another often overlooked factor is mindset. Most people see debt as a monthly payment. Wealthy people see debt as a percentage and an opportunity cost. They ask questions like, What is the real interest rate after tax deductions? What is the expected return on the asset? How does inflation affect this loan over 10 or 20 years? When you think this way, debt becomes a strategic variable rather than a source of fear. Public data supports this. Studies from institutions like the Federal Reserve and OECD show that higher-income households tend to carry more debt in absolute terms, but far less relative to their assets. Their net worth continues to rise because their debt is productive. Lower-income households often carry less debt overall, but more high-interest consumer debt, which erodes financial stability. The issue is not debt itself. It is debt quality. This does not mean everyone should rush out and borrow money. It means understanding the rules before playing the game. Debt should only be used when it aligns with long-term goals, stable cash flow, and realistic expectations. It should never be used to impress others or escape short-term discomfort. Wealthy people think in decades, not months. Ultimately, debt is a tool. Like any tool, it can build or destroy depending on how it's used. A hammer can construct a house or break a window. Debt works the same way. When used with education, patience, and strategy, it becomes one of the most powerful wealth-building mechanisms in modern economies. When used emotionally or recklessly, it becomes a lifelong burden. So the next time someone tells you all debt is bad, remember this: the world's financial system is built on debt. Governments use it. Corporations use it. Investors use it. The wealthy are not afraid of debt. They are afraid of bad decisions. Learn the difference, and you begin to understand how wealth is really created. If you found this explanation valuable and want more clear, real-world breakdowns of money, investing, and wealth-building strategies, make sure to subscribe to the channel. New videos are posted regularly to help you think differently about money and build a stronger financial future. Your support helps the channel grow, and your knowledge grow with it.